DSCR loans and what no one tells you about them. Hey guys, it's Sal Bossio with Mortgage Universe, where real deals get done. Today, I just wanted to cover DSCR loans and what they really are, hidden rules about them, the mistakes that a lot of borrowers or investors make, what separates a great DSCR loan from a loan that's going to drain all your cash flow. So what a DSCR loan is, debt service coverage ratio. It's how lenders qualify an investment property based on the rental income and, of course, not your personal income. Rent covers the mortgage, the loan is approved, right? Obviously, there's other factors, and those are things we're going to talk about today. But typically, yes, if your DSCR is 1.00, the rent covers the mortgage exactly, right? So your mortgage payment equals your rent, vice versa. If it's 1.2, well, then you've got an extra 20% in cash flow on your rental property. So that's actually a really good position to be in. Lenders love that, obviously. They want to see that there is actual cash flow on the property. You might even get a better interest rate for that. And then, of course, there's being low ratio where the rental comes in a little bit short. Those rates could obviously be a little bit higher just because it's a little bit riskier. You don't really have the leverage that the lenders are looking for, but there are lenders that will still approve the loan that way. Now, here's what lenders don't tell you. I get a lot of questions from borrowers where they're just like, I can just close I could just do it in an LLC, right? And I said, yes, of course, but there has to still be one person that guarantees the loan. So you can close in an LLC, but most lenders still require a personal guarantee, right? A guarantor, rather. Some also require you to have a certain percentage in that LLC. So like, just closed a deal, I didn't close it yet, but I just got a clear to close on a deal that he was only 50% owner, and then the other 50% was with his wife, and we only had him on the loan. Lender never mentioned to me that unless they're at least an 80% owner in that LLC, we would have to include the other member on the loan, which kind of messed things up because that borrower, his wife, might have had additional debts in her name that would have messed up my DTI. I'm actually talking about not a DSCR loan right now, I'm talking about a different type of loan. But this applies to DSCR loan as well, where on that LLC, they require you to have a certain percentage ownership, right? So you can't be a 10% owner on the LLC and then another person 90%, but the one that's 10% be the one guaranteeing the loan, as the guarantor on the loan. That doesn't make any sense. Typically, they want the borrower to have at least 80% ownership if that's the only borrower that's going to be on the loan, right? Now, if it's 50-50 and you want to put both people on the loan, that's fine. Every lender is a little bit different. So one of the biggest, I guess what I'm getting at is one of the biggest mistakes is not discussing number one, the ownership in the LLC needs to be discussed with the lender, and there should be clear communication of how they want that loan to go through. I'm doing one right now where it's 70-30, and I'm just thinking of this. They didn't mention anything. I only have the borrower that is 70% on the loan, and the 30% holder is not on the loan at all, and I have a clear to close. They didn't say anything about it. However, some lenders would require 80%. So I guess I got lucky on this one because they didn't, otherwise I would have to add the person on the loan, which is not a big deal, in this case, because I know he's got good credit and we don't have to worry about income or debts. So it wouldn't have been a problem, but, so that's one, thing that you have to look at is LLC ownership. A lot of borrowers, think that they can just close in their LLC, brand new LLC that you can just create, which is fine. There's no seasoning typically on the LLC. You can create one day and then the next day apply for a loan to close in that LLC. However, there are many borrowers that reach out to me that say, well, why can't I just close in the LLC? Well, you can, but you still have to you're the one on the loan. Not the LLC is not the one on the loan. You're the one on the loan. Number two, reserves matter. Most of these lenders, not all, but most will want you to have at least 3 to 6 months reserves in the bank for this particular property. So let's just say the mortgage is $3,000 a month. They want you to have an extra $18,000. 3 times 6 is 18. They want you to have an extra $18,000 in the bank as reserves in case something goes wrong. You have money there. So Not every lender requires it, but it is becoming, with these DSCR loans, I'm noticing that they are becoming more and more strict on regulations, depending on the lender. Some lenders that only do DSCR loans are a little bit more loose with their investor guidelines. But some lenders want 6 to 12 months reserves, that could include, personal, business, retirement funds. It just, again, depends on the lender, but that's another thing. So that's number 2, is it's very helpful to have reserves. And if you don't, we have to find a specific lender that is a little bit more lenient. DSCR obviously isn't the only factor. As we've talked about in other DSCR videos, lenders require you to have a minimum credit score. I'm seeing out there emails from tons of lenders that are advertising as low as 620 right now, which is awesome. When I started really doing DSCR loans, 680 was the minimum, so they've reduced that. But with a 620 credit score, you would typically have to have more money down, right? So they're not going to do a 20% or an 80% LTV loan, so 20% down from the borrower. With a 620 credit score, usually they're going to want you to put at least 30% down for, so there are ways to do it for lower credit score borrowers, but a property as well. So property type, if it's a single family versus a condo, if it's a long-term rental versus a short-term rental, these are all factors that, have to be a part of the conversation that will affect whether or not this type of loan can work for you. So another thing is that a lot of people don't consider is overestimating rent. So a lot of borrowers will come in and they'll say, I think I'm going to get this much money on the rental each month, $2,800 a month, whatever. But the market rent from the appraiser comes in at $2,500. So now we have a property where the mortgage, including tax and insurance and maybe HOA, sometimes the borrowers forget, we got to include HOA in that, right? So high taxes, insurance, HOA, those can throw things off, especially if the rent comes in lower. Now, one way to kind of rectify an appraiser with it coming in low with their 1007, which is the form that they use to determine the market rent, is to just simply get a 12-month tenant in place, right? So sometimes we have to say, hey, the DSCR is low because the market rent came in low. So we can either do one of two things. We can put 5% extra down, go from 20 to 25%. Sometimes the borrowers just don't have it, or they don't want to use that. They'd rather, hold on to that cash. So another option is to see if they can find a tenant and have an executed lease before we close. So if we can use, in many cases, up to 125% of the difference. Basically, so if the, if they can find a tenant, so let's just say the mortgage is $2,800 with everything, right? With taxes and insurance, HOA. If the rent comes in at $2,500, we've got a shortfall. We're basically at 0.89, right? If this particular lender doesn't allow low ratio, and we want to stick with this lender instead of move the loan to a different lender, the borrower can find a tenant at $2,800, right? If they can find a borrower at $2,800, we can then use that lease instead. And instead of using the 1007 that came back from the appraiser, we can use the rental agreement at $2,800. Now, what you can't do is have too wide of a gap between the 1007, what the appraiser says the market rent is, and what what you think you can get in rent, right? So for example, you can only go up to 125% typically of that rental income. So let's just say the appraiser comes back at 2,200 times 1.25. So 125% of 2,200 is 2,750, I think. Hold on. 2,500. So times 1.25. Yeah. So I was right. 2,200. So let's just say the appraisal came in really short. Okay, as far as the market rent goes, 2,200 when you thought it was going to be 2,800. Okay, you can adjust the market rent. You can adjust the market rent up to 125% typically of that renters of what the appraiser said that value would be. So 2,200 times 1.25, which is 125%, that's 2,750. So you can get a rental agreement for up to 2,750, where you could be whatever you want. It could be 2,800 if you want, but the lender will only use up to 2,750, which is 125% of the appraiser's market rent analysis. You can't just say I'm going to find a renter at $3,000 or $3,500 and that's it. It would be a red flag. It wouldn't match. It wouldn't make sense. So there are limitations, but there are ways to rectify it. So between overestimating rent and ignoring tax and insurance, because remember, DSCR is based on the principal, interest, tax, insurance, and possible HOA, not just the principal and interest. So those extra costs can really make or break your ratio.